Hey there, Brad Castor from GridOptionTradingStrategies.com. I've talked about the issue of selling covered calls for income versus selling cash secured puts for income in previous videos, and I've showed how covered calls and short or naked or cash secured puts can be structured so that they're 98% the same trade in terms of both returns and outcomes. But today I want to drill down more on that 2% difference part. And this is important if you sell options primarily for income, or if you aspire to, or if you're just getting started. Are you using the best strategy for your situation and for how your own brain is wired? But before we get started, I've added links in the description section to relevant videos and videos I'll be referencing today. And that includes the video where I do a deep dive and show you how covered calls and cash secured puts are 98% the same trade when you're working with the same strike price and expiration date. And as always, I've also got links in the description section to a ton of other option selling and even option investing resources for wherever you are in your options journey. So really quick, and again, if this isn't really clear or you'd like to see a deeper dive on this, be sure to check out that earlier video. But I'll run through a quick example to show you what I mean by covered calls and short puts essentially being the same trade. And I'll use a real world example here, just pulled at random as I'm putting together the video. Now, I'm not recommending this trade, but rather just highlighting it because it's a relatively clean example to illustrate what I'm talking about. So here, Tesla is trading at $399.05 a share, or pretty close to $399. And as you can see in this option chain, I could go out 37 days and sell an August 21st, slightly out of the money, $395 put for, I'm betting somewhere around $21.30 a contract. The bid-ask quote is $21.25 to $21.45, and I'm assuming I could improve the fill price by 5 cents. What that means is that, in effect, with Tesla trading at $399.05 a share, I'm offering to buy 100 shares at a slightly lower price, $395 a share. And in the process, I'll collect $2,130 upfront, less commissions and fees. So what I'm really doing is insuring someone else's downside. Theoretically, of course. As a practitioner of what I call the insurance company from hell model of put selling, where I sell lots of premium and then avoid like the plague ever paying out a claim, I would have no intention of buying the shares if the stock traded lower on me. But that's a trade repair conversation for another day. Today we're having a different conversation, and that's about the relationship between covered calls and naked cash secured puts. So let's look at the covered call version of the same trade. And that would be an in-the-money, buy-right covered call at the same August 21st expiration date and $395 strike price. So in this version of the trade, I would simultaneously buy 100 shares of the stock at $399.05 a share and then sell that August $395 covered call for $27.05 a contract. Again, there's a 20-cent bid-ask spread, but I'm estimating that I could improve the fill price on the bid by 5 cents a contract. So after commissions and fees, I would collect $2,705 of premium upfront. So far, the covered call version seems to be winning as I'm collecting a lot more premium upfront. Except if Tesla expires still trading above $395 a share and I do nothing, my covered call will be assigned or exercised against me and the shares will be called away from me at that $395 strike price. In other words, I'm going to lose $4.05 a share on the trade from selling a stock that I paid $399.05 a share for $395 a share. That's why I received more from selling the covered call than I did from selling the cash secured put, because some of that premium was in the form of intrinsic value, or how much my covered call strike price was below the current share price when entering the trade. So if I back out that $4.05 a contract, or $405, from the $2,705 total premium I collected from setting up the covered call, that works out to be $2,300. By definition then, that's the extrinsic or time value amount that I've sold. Now that still beats the $2,130 of comparable time value I sold with a $395 short or naked put. On an annualized basis, the cash secured put version of the trade works out to be 53.20% annualized projected over 37 days until expiration. And on the covered call version of the trade, the annualized rate projected through expiration would be 57.44%. That's a difference of 4.24% annualized. Now get this, the current yield on 1 to 2 month T-bills, which would be the risk-free interest rate environment during this 37-day trade on Tesla, is right around 3.7%. We'll drill down on the interest rate factor a little later in the video, but the short version is that 3.7% of the 4.24% difference between the put and call annualized pricing is because of interest rates, not skew. So the pricing difference is not the result of a huge imbalance between calls being traded and puts being traded. Now you can have fun and look up more examples and see all this for yourself. But factoring in the interest rates, the returns are very similar between the short put and covered call versions of the trade, which is only about 0.5% difference on an annualized, not total basis. But in addition to nearly identical returns, I also said that covered calls and cash secured puts also resulted in the same outcome. And what do I mean by that? Well, you may start these structurally different trades very differently, but there are two outcomes at expiration. The stock is either trading above $395 a share or it's trading below $395 a share. And in either scenario, after expiration, your brokerage account will look exactly the same. Let's run through this real quick. If Tesla ends at expiration trading above $395 a share, and I went the $395 short put route, that put expires worthless, the premium I collected is mine free and clear, and I own 0 shares of Tesla because none were assigned to me. And if I'd gone the covered call route, because the covered call expired in the money or above the $395 strike price, that call is going to be exercised against me and the shares called away for $395, which was my objective, of course. Or as I say, these buy right in the money covered calls are designed to be assigned. As we've already discussed, I have to back out that $4.05 per share expected loss, but the extrinsic or time value portion I collected represents my free and clear profits, and just like the put seller, I have 0 shares of Tesla because I was forced out of the shares I did have. And if Tesla is trading below $395 a share at expiration, well, if I'd sold or written a $395 put and did nothing to avoid it, I'd be assigned the shares at the $395 strike price, meaning I would now have 100 shares of the stock with an adjusted cost basis of $395 a share, less the premium I collected when first selling the put. Surprise, surprise, the covered call version produces the same results. If the stock is trading below $395 a share, my covered call expires worthless. I retain my shares, so like the put seller, I have 100 shares of Tesla, and they now have an adjusted cost basis of my original purchase price less the total premium collected. Now, total premium here is going to include that $4.05 of intrinsic value, which offsets the extra $4.05 per share that I paid for the stock when setting up the trade. Presto, no matter how you slice or dice it, you get the same results and outcome. But you might be wondering, what if Tesla ends exactly at $395 a share at expiration? Well, in theory, both versions of the trade would see their contracts expire worthless. Automatic assignments are triggered for most brokers if an option is 1 cent a contract or more in the money. But when it's that close at the end, I don't think you can assume anything. And of course, there's a lot that can still happen in the after hours with the stock fluctuating in price. And technically, options can still be exercised for a while after the market closes. Okay, so after going through this hypothetical Tesla trade structured as both a covered call and as a cash secured put, and looking at the two different outcomes, basically whether the stock is trading above $395 a share at expiration or below $395 a share at expiration, which version do you think, covered call or cash secured put, is actually easier to track? With the out of the money short put, you know immediately how much time value you're selling, which is 100% of the premium collected. With the in the money buy right covered call, however, you have to manually separate the intrinsic value portion and deduct that from the total premium collected up front in order to determine how much time value you're actually selling. Now keep in mind that the Tesla example here is pretty clean, with the stock trading almost right at $399 a share, which is why I chose it. But what if Tesla had been trading at, say, $398.63 a share when I entered the $395 buy right covered call for, let's say, $27.81 a contract? Not so easy to quickly calculate the time value portion in your head there, is it? And it's also going to take more effort tracking remaining time value over the life of the position. With the short put, as long as it stays out of the money, whatever premium levels remain will, by definition, be comprised entirely of time value. But with the covered call version of the trade, you're going to have to keep manually deducting $3.63 from whatever the current bid-ask quote is over the life of the trade to figure out how much time value is left at any point in time. Now, this video is not about trade management, but no matter how you structure your option selling trades, you really need to monitor remaining time value to optimize the timing of any rolls or adjustments you make, or when determining the best time to take profits on a winning trade. And from experience, I can tell you that's a lot easier done when dealing with an out-of-the-money short put versus an in-the-money covered call. So that begs the question. When it comes to selling options for income, which I define as the time value portion of the premium you collect, given that the put selling structural version of the trade is so much easier to understand and track. And if you disagree, please let me know below. Why would anyone sell in the money covered calls for income over out of the money cash secured puts? That was actually a question that a daily option tips and insights newsletter reader asked me recently. And it was a great question. There are actually 4 reasons why someone might structure an option selling for income trade as an in-the-money covered call versus an out-of-the-money cash secured put. Even though, in my view, it's pretty obvious that the put selling version of the trade is much easier to track and understand. But before we go through those 4 reasons, if you're not already subscribed to the Daily Tips newsletter yourself, you might want to consider doing so. And you can do that by signing up directly or by downloading any of the ebooks, strategy guides, special reports, or case studies that I've linked to in the description section below. There are a number of perks to being a Daily Tips newsletter reader. In addition to actual daily option tips and insights involving trade selection and setups, trade management, and hugely important, trade repair, I also occasionally share a real-world leverage investing club trade in real time. Another perk is that if you want me to take a look at any of your own trades, especially if they've gone against you, I'll be happy to take a look and give you my thoughts as a 25-year option trading veteran and give you some choices to consider. I also occasionally share what I call secret seminars exclusively with Daily Tips readers. These are more in-depth article or video series where we really drill down on a specific aspect of option selling. The newsletter also complements the YouTube channel very nicely, as some topics are better suited in article format and some are better suited in video format. And I'm also able to put out more articles each week than videos. Best of all, the Daily Tips newsletter is not a spam fest. I never promote third-party products or services, and while you might get 1 to 2 invites to join the Leverage Investing Club per calendar year, 95% of the time, I'm just showing you what works and what doesn't. Okay, so let's look at the 4 reasons why someone might choose to sell in-the-money covered calls rather than selling corresponding out-of-the-money puts, even though out-of-the-money short puts are simpler to trade. The first reason is simply familiarity. Now, I don't have an official source to back me up on this, but I think it's a pretty safe bet that there are a lot more covered call writers out there than there are put sellers. And let's face it, far more beginning traders start out with covered calls than they do with naked puts. I also see it firsthand on this channel. In general, my covered call videos tend to get considerably more traffic than my put selling videos. Now, I also think that the majority of covered call writers are doing something more than just a pure income play. I think most are working with out of the money strike prices as a way to benefit from, hopefully, upside moves in the stock while still bringing in income. I've got a couple of videos linked below that explore the pros and cons and implications of setting up covered calls at different strike prices. But an out-of-the-money covered call at a strike price the same distance from the current share price as an in-the-money covered call will contain very similar, if not identical amounts of time value. In other words, the same amount of income. For example, if a stock is trading at $35 a share, both a $32.50 covered call and a $37.50 covered call would have similar, if not identical amounts of extrinsic or time value. The big difference, of course, is how much more downside protection the $32.50 strike price gives you over the $37.50 strike price, as the downside break-even or cost basis in each would be calculated by taking the $35 price paid less total premium collected. Since the $32.50 covered call also includes $2.50 of intrinsic value, whereas the $37.50 covered call would have 0 intrinsic value, that's a huge difference. But to illustrate that, I think we need to walk through it. So let's say that both the $32.50 and the $37.50 covered calls each contain $1 a contract of extrinsic or time value, meaning you could sell the $37.50 covered call for $1 a contract or the $32.50 covered call for $3.50 a contract, $1 of time value and $2.50 of intrinsic value. The cost basis or break even on the $37.50 covered call would therefore be $34 a share. And in contrast, the cost basis or break even on the $32.50 covered call would be $31.50 a share, because you're buying the shares for $35 and then you're deducting the $3.50 of premium collected. Okay, on a quick side note, this really illustrates something I say a lot. Options are always about trade-offs. In this case, do you want less downside protection in exchange for income plus a shot at some capital appreciation? Or do you want a much safer trade with greater downside protection that focuses exclusively on income and be willing to give up the potential extra capital gains? Okay, second reason is that some traders have to trade covered calls because they're not allowed to sell puts. This is a bizarre situation, but Canadian traders who trade from registered or tax advantage accounts are prohibited from selling puts, even cash secured puts. Now, I understand restricting traders from selling puts on margin and retirement accounts, etc., where you sold more puts than you have the cash to accept full assignment on everything, but Canadian brainiac regulators are apparently too clueless to recognize that a cash-secured put and a covered call are the same trade. So most of our Canadian Leveraged Investing Club members go the covered call route. And one of the follow-up courses included in Leveraged Investing Club membership is one called Ultimate Covered Calls, where I demonstrate step-by-step how to replicate our core put-selling based sleep at night strategy using covered calls rather than naked puts. And inside the club, we set up trades both ways. Okay, a third reason why some folks go with in-the-money covered calls versus out-of-the-money short puts is due to the current interest rate environment. Now, this is not widely known, but interest rates do impact the pricing of puts and calls differently. In fact, this is something that I didn't fully understand myself until COVID inflation hit and we finally exited from the low, no interest rate environment a few years ago. In the option pricing model, rho is the Greek that measures an option's sensitivity to interest rates. The higher the interest rates go, the more expensive a call option's price will be versus a comparable put option. Think of it this way. A covered call writer is being compensated for tying up his or her capital by buying stock versus having that cash earn risk-free interest income in a high-yield money market or owning T-bills, treasuries, etc. You can run the numbers and check this out yourself by looking at various option chains and selecting specific call and put strike prices for an expiration of your choice. If you isolate the time value available on both the call and the put, and then annualize that over the days until expiration, you'll see that the call version has a higher annualized rate than that of the put. And it should more or less correspond with current T-bill rates, which are currently in the 3.7 to 3.8% range. So if an out-of-the-money short put trade offered terms of 20% annualized, the in-the-money covered call version, the time value portion, would likely be offering somewhere around 23.5% annualized, maybe a little bit higher. So what that means is if you're trading completely on a cash secured basis and the cash in your brokerage account is not securing your put selling trades via a high yield money market or via T-bills or a T-bill ETF, it does make sense to structure these trades as covered calls. But if the cash you're using to secure your put selling trades is earning T-bill equivalent rates, it's generally going to net out so that you're not really losing out by selling puts instead of covered calls. But if you're using any form of margin, selling puts is definitely the way to go because you pay no margin interest on short puts. But if you buy stock on margin to sell covered calls, then yes, you're going to be paying margin interest, and that can add up pretty quick. Also, selling puts on margin, assuming you're successful, can bring in considerably more premium than that little extra income you're getting from the covered call version of the trade. And finally, a fourth reason why traders might go with covered calls over short puts is because of dividends. Now, a lot of newer traders, and also a lot of not so new traders, think they're actually getting a bit of a free lunch when writing covered calls on dividend-paying stocks, like they're getting paid twice. Well, technically they are, but the catch is that they're actually getting paid less on the covered call portion. Basically what happens is that Mr. Market mentally adjusts the option prices on any option that crosses an ex-dividend date to reflect that the quarterly dividend is leaving the balance sheet. For example, if a stock pays a quarterly dividend of $1 a share, impacted options will be priced as though the stock is currently trading $1 a share below its current share price. That means call pricing takes a hit and put pricing gets a boost. So all in all, it's a bit of a wash. Also, it impacts options that are closest to the money the most and those farther away from the money the least. So what we've done in the past is if we find ourselves in a trade repair situation on a deep in the money short put, where the stock is now trading well below our current short put strike price, and the underlying stock pays a good dividend, we'll allow assignment and continue managing and repairing the trade from the covered call side of things. Because in that situation, we're going to collect more from the dividends plus the future covered call net premium over the future short put net premium by itself. Hopefully that makes sense, but if not, let me know in the comments. We actually did this last year on a Papa John's pizza trade repair situation, and it ended up generating some really great returns, all things considered, and those dividends definitely added to the bottom line. I've got a 23-minute deep dive video I did covering that pizza trade repair and why we switched to covered calls on it, and you can find that link in the description. It's definitely worth checking out. The stock fell on us at one point, 55.19%, and yet we walked away with 26.19% annualized over the holding period. No joke. Okay, if you enjoyed this and want more option selling resources, be sure to check out the channel's other videos and playlists and subscribe. We're just about to hit the 1,500 subscriber milestone, and I've got a backlog of other videos in the works. Also, sign up for the Daily Tips newsletter via the pinned comment below. The newsletter is a tremendous option selling resource and really complements the YouTube channel, as some topics are better suited in article format and some are better suited in video format. Both resources are all about heads you win, tails Mr. Market loses, so the newsletter is a resource you're going to want. And as I mentioned earlier, there are other important perks of being a Daily Tip subscriber. I occasionally share an official club trade in real time. I routinely help subscribers with their own personal trades, and I periodically send out what I call secret seminars where we really drill down on some specific aspect of option trading. And yes, all of this is free. You can sign up directly, or there's also a link in the description section below to the Great Option Trading Strategies downloadable library page. Download anything from there, and you'll also begin receiving the Daily Tips newsletter automatically. Heads we win, tails Mr. Market loses. Let me help you come out ahead on virtually all of your trades. Okay, until next time.